Nisa Bulabanaka Shalom Alakim and Ra'e Moli. Nice to Atakwa. Today I'll be talking about fijian jafa capital investments, a study on Australia New Zealand Banking Group Limited and in Australia liquidity risk and its determinant. So this was written by Yi Hu Min of the School of Economics, Finance and Banking at Northern University of Malaysia. And the abstract. The primary goal was research into why bank-specific factors and systematic risk that may influence NZ liquidity risk. 12 bank-specific factors, 5 systematic risks, and a combination of 2 aspects that may impact liquidity risk of NZ. Will focus on this research. To meet the study objective, the connection between those factors and liquidity risk is determined utilizing statistical and regression methodologies. It is undeniable that over the last decade, Australian banks have adapted to stricter regulatory capital and liquidity requirements. However, liquidity risk will still arise in the bank as a result of immature information, which means they borrow money for shorter periods of time they lend out. The keywords in this article is ANZ, liquidity risk, RWA, banking industry, and Australia. Okay, and the introduction, 1.0 introduction. The first chapter delivers a comprehensive summary of the chosen bank, Australia and New Zealand's Banking Group Limited ANZ, with emphasis on history and background. Following that, related risks that ANZ faces will be analysed, followed by its research objectives, as well as research questions. Background of Australia and New Zealand Banking Group Limited ANZ. Essentially, Australia and New Zealand Banking Group Limited ANZ is a global financial and banking services corporation that ranks among the world's top 50 banks, Australia's top 4 banks, United Nations Environmental Programme, Finance Initiative, ND, not updated, close parenthesis. It has a 186-year history. Accounts checking savings, deposits, mortgages, and term loans, money and market accounts, as well as internet banking and card services are all available at ANZ. ANZ is located in Melbourne, Australia. In terms of assets, it is Australia's second largest bank. In terms of market capitalization, it is the third largest. They operate in 32 markets, serve approximately 8.5 million retail and business clients by offering banking, lending, and financial goods and services in Australia and New Zealand Bank Group Limited ANZ 2020. Bank of ANZ as well. And I studied postgrad at AUT University for gap year. In 1885, it was established the Bank of Australia in Sydney. They moved to Melbourne in 1838. The Bank of Australia's first branch was set up in 1985 by George Crinier, a young Scottish entrepreneur. Therefore, the ANZ Bank was formed in 1951 by merging the Bank of Australasia and the Union Bank of Australia, both of which had been formed in 1835 and 1837 respectively. On October 1st, 1970, Australia and New Zealand's ANZ Bank combined with English Scottish Australian Bank ASNA to the present corporate organisation. It was the biggest bank consolidation in history of Australia. It results in creating a society in which individuals and community prosper, they deliver, connected up to date, and in which individuals and communities prosper, deliver connected up to date and efficient services, technologies, and insights, both directly and in collaboration with others, improves the client's monetary well-being, sustainability. Shane Elliott is currently the Chief Executive Officer of ANZ. Position is held since January 1st, 2016. Problem statement. Undoubtedly, banks are involved in a wide range of risks: credit risk, operational risk, and market risk. Liquidity risk and interest rate risk are all major risks in banking. Thus, risk management is essential for banks to maintain their financial soundness. The research will examine and identify the main risks that ANZ confronts, which is liquidity risk. The first issue and problem relating to liquidity risk in ANZ is the high leverage ratio, which is also one of the most volatile variables in ANZ. Since the leverage ratio is volatile, it will render the company faces higher financial risk. ANZ's high leverage ratio is generally determined by a combination of greater equity and debt use to fund operations as a more financial leverage ANZ used. When ANZ's capital is mostly borrowed, the debt ratio of the company will become higher. Increased capital reserves are required to satisfy high leverage ratios, which demand the bank sell assets to raise cash or reduction of lending. Hence, the liquidity will also be directly affected. Of course, the law of ANZ cannot convert its assets to cash promptly. Secondly, according to Sanglab 2020, after reserving 2.7 billion in credit impairment charges, ANZ revealed its cash earnings dropped by 40% the 30th September 2020 to 3.67 billion. In addition, the bank recorded a 30% increase in operational expenditure the same year, wage costs increasing to 4.7 billion. Subsequently, as technology expenditure grows to 1.57 billion, accounts of cash operating expenditures and ongoing activities to 8.61 billion. Moreover, over the next 2 years, COVID-19 is forecast to significantly affect the Australian bank profits. The profitability of banks will be affected by interest rates, slow credit expansions, a decrease in free income, as well as higher credit losses. The ANZ might be in capacity to maintain business volumes, which might ultimately lead to insolvency and enable unsatisfied obligations under challenging conditions such as low levels of liquidity. They don't have enough money out of income quality equity, assistant with cash to pay the debt or fund cash outflow. For those who are not aware of criminal behavior, a lot of gangsters do money laundering. Money laundering is when you sell drugs illegally and you fund it through businesses to try and make it look like it's legal money. So legal money is called money laundering, called legal trade. That's what criminals do. Additionally, according to Reuters, news by Dura in 2021, the ANZ reports significant profit increase of 0% in 2021, but claims they have lapsed in house lending. However, ANZ has benefited from restoring a money market many bad loans, cover losses caused by the pandemic, leading to a decline in liquidity and the possibility of facing liquidity risk. ANZ admitted it had performed enough to take advantage of the pandemic-induced surge in house financing. The introduction, I could read the introduction. The chapter implies in conducting comprehensive literature review for the study. International banks considered with the particular focus on liquidity risk, performance, operational risk, and other market risk. In terms of liquidity risk, Hongwood et al. 2001 explains the hazard of banks and their ability to respond promptly and comprehensively to satisfy the commitments which they due, for instance, the payment and deposits, loans payable, and other financial activities is known as a liquidity risk. Other than liquidity risk, there is also a possibility that as an owner will not be able to obtain the full amount of that asset or some to sell it. According to the research conducted by MK et al., when a bank's liquidity is limited, they can't acquire cash quickly enough, regardless of expanding liabilities, transforming assets, the fair value, and eventually has a negative influence on the bank's performance. The research also revealed that liquidity risk is an internal factor that affects bank performance. Bodies of study done by Chamal et al. In Africa, which use ROA and ROE variables to affect bank performance, discloses the presence of negative connection between liquidity risk and bank performance, which if banks have high levels of liquidity, won't better in terms of profit than banks low liquidity levels. The cash ratio is most often used as a benchmark in evaluating a company's liquidity. Cash ratio refers to an asset's capacity to be converted into cash. It is computed by dividing the company's total cash and cash equivalent to total assets. Banks also can use leverage ratio, risk-free capital, debt to equity ratio, equity multiplier, and debt to assets ratio to gauge equity risk. Furthermore, liquidity risk is grouped into two categories, which are funding liquidity risk and market liquidity risk. Divine funding liquidity risk is probability that the bank might be able to pay its debts and schedule organized liabilities, assets, and investor sources of funding. Meanwhile, market liquidity risk and the risk of attributable and negative good market depth or market disruptions. Bank may be effectively to effectively exit offset certain exposures about constantly substantially decreasing prices on the market. Credit risk. So pick your credit score. The general Basel Community and Spark Bank Supervision 2000 mentioned that credit risk is a risk in Mrs. Data. The counterpart of bank might refuse to satisfy its commitments as implied by general agreed upon conditions. On the other hand, credit risk is trading instruments is expressed in the incremental risk charge, whereas IFC was the risk of loss due to default and credit migration occurrences. Loans are the most significant and apparent source of credit risk for most banks. Nevertheless, numerous credit risk sources are present across the whole operation of the bank, including in the finance and banking books as well, and of the statement of the financial position. Non-performing loan ratio computed by dividing the non-performing loan by the total loan and other credit risk indicators because of measures and percentages of loan losses and the proportion of the entire loan amount. The core of the concept of non-performing loan entails total loan funds for which the individual has failed to make regular payments for those more than 90 days. Moreover, moreover, according to Bient et al., the analysis of banks' borrowers' risk profiles reveals that the riskiness is based on debt to income ratio. Total liability is driven by net income. A large decline in financial status and consequently increased in credit risk because of the increased degree of perceived risk. Rising the traits of customers and the business environments in which they find themselves. Problem credit risk is even higher impacts on banks. Risky sector loans, loan loss provisions, risk-weighted assets, and the other significant considerations and evaluations bank settle credit risk. In the research from Improvowitz and Ranch, liquidity risk can be defined as a property expenditure. Thus, the loan payer raises turn liquidity risk to depreciation while this a cash inflow. Furthermore, if there are an increasing number of economic projects, financial loans that are yielded no good money or even defaulted will eventually cause banks and other means to depositors demand, hence due to asset depreciation, growing number of depositors requesting money back. Ultimately, the bank withdrawing all loans and therefore significantly reducing market liquidity. And in conclusion, liquidity risk and credit risk should have been positive connections, other than bank stability simultaneously. However, according to study conducted by the core, higher risk may result liquidity risk when interbank composition is minimal. Thus, in case of the bank, liquidity risk and credit risk should have a negative relationship. In terms of performance, according to Keki et al., profitability are one of the most four categories utilized by firms for financial reporting. Performing analysis, the main few factors are efficiency, liquidity, and marketing and prospects. Investors, lenders, and managers utilize those critical assessments in order to assess the company's current and future performance. Activities carried out successfully means that profitability is one of the most relevant indicators used when judging company's performance. As a company's efficiently creates profits may use this benchmark. As the profitability, the stronger the status of the firm, according to analysis and profitability ratios. To examine the bank's profit in relation to a certain amount of an asset, investors' investment return. Returning on equity ROE, managerial efficiency, bank size, return on assets, ROA, essential measures on bank profitability in the industry. The main gauge of management efficiency as ROA is indicator of the capital of the bank's administration and income of the assets of bank. Meanwhile, the ROA is measure of property of a company is. Return to asset ROA is computed by dividing profit of tax by total assets. By the return on equity ROA is defined in ratio net profit, that's total equity. According to a study performed by Children Saban, they revealed that liquidity risk has a positive influence on bank performance. Applying the larger the liquid risk, the better the bank's performance. I'll skip operation risk, go to market risk. Systematic risk is involved with the bank's assets, which values are affected by systematic variables. It is also known as market risk, and banks remain involved in market activity. And pricing is consistently transacted in the financial markets with title of the market risk. According to Alexander, market risk is a risk posed by a drop in the price of a good financial asset. Furthermore, Reagan, 2003, explained that market risk refers to the risk that adjustments in the prices of securities, stocks, foreign exchange, and fluctuation of such values and market interest rate pose a risk to banks' earnings and capital, changing the equities and interest rate markets, commodity prices, and currency exchange rates that have the potential to negatively influence the value on off-balance sheet assets. Owing to quick changes in market conditions that are able to produce huge financial losses and even collapse market risk exposure to more variable credit risk exposure. Essentially, market risk may be seen during the yield curve, GDP growth, inflation, PD growth, and outward cap. Methodology, statistical technique. In terms of the data analysis, you can't see it, so I'll just turn my computer on so you see this. In accordance with future research framework, the research included dependent variable and three independent variables. The ordinary last square LLS approach is used to investigate the association between independent variables. Dependent variables. Multiple regressions are utilized because of the research attempting and anticipate a dependent variable value based on more independent variables. Value source of analysis combines all the most independent variables that help forecast the dependent variable value. Calculate the coefficients of the linear equation. Following as research framework is top one is liquidity risk, dependent variable, LR, systematic risk, bank specific factors, and bank specific systematic risk, which is dependent variables. I need we got these liquid ratio and bank specific factors calculations and systematic calculations as well. That's what I need to work on for my finance paper. There's ratios, variables, and measurements. So below is typical measurements. You got leverage ratio, risk loan ratio. So that's what accountants are good at. You can be a CFO, Chief Financial Officer, which is under the Chief Executive. There's a lot of statistics here that I need to start studying for my finance paper. Got correlations, graphs that you have to study. I have a finance paper and postgrad next semester, and a sports innovation paper next semester. It's the reason I'm studying doing papers on finance and capital investment. When you learn how to read articles as a doctor, you read the introduction, you skim the body, and then you should read the conclusion. That's also my Dr. Hamish Brimler on how to read articles. So I just read the conclusion, discussions, and conclusion. The chapter summarizes the results of findings in the self-report regards to credit risk encountered by ANZ. A detailed discussion of the study's demonstrations were presented below. Lastly, the research provided recommendations and the issue raised in ANZ. Discussion and result. Based on the table of correlation, RWA is most sufficient correlation available in the liquidity of ANZ. A p-value of 0.1 among all the specific factors and systematic risk has been followed by ARS, a value of 0.60 and respectively. It also reveals that WA can be significantly correlated in ANZ's liquidity ratio, which implies that even ANZ Bank holds more risky assets, they would have been less liquidity and as a result face more liquidity risk. On the hand, the model summary table is based on only three bank perspective consist of management efficiency, this asset ratio as well as regulatory capital explains the liquidity ratio of ANZ. However, the coefficient table reveals that three factors of consideration are not significant to the liquidity ratio aspect of systematic risk. The model summary table materials disclose that only three external factors, namely output and gap inflation near the curve, explain the liquidity ratio. Now, this is the result of the coefficient table in Model 2 generates the identical conclusion in Model 1, demonstrating that pre-existing places of concern are significant to the grid ratio. Further, Model 3's model summary table shows that only three internal external factors for comprising output gap MP group and regulatory capital and contribute. There is equity risk, but also variables and are segmented to the grid ratio as well as the Model 3's coefficient table. In terms of limitations, one of the limitations study restrictions was Lawton and the company rather than the whole bank sector in Australia, which is analysis for sample size is too small, and spring significant nations from that level will be challenging. This is because in order to achieve a representative distribution of the population, regardless of groups of population to test, you demand a large sample size. Moreover, the period of time that searches the study the research issue, in order to change the period of time to the review date, the research picked up a researcher consumes time to perform ministry review, but it's unique collects as well as the value data. In terms of recommendations, based on analysis and discussion above, the researcher came to the conclusion that RWA is most significantly correlated ANZ's liquidity and liquidity risk. Thus, the researchers suggest ANZ should evaluate the loan quality before lending clients as well as having equivalent capital proportion to the amount of risk associated with the assets they hold, as opposed to the risk taken by the bank. More capital is required to safeguard depositors, and lessen the chance of becoming insolvent. If the bank suffers operating losses without operating, capital also serves as a cash buffer. More modifying product structures, client paperwork, helping a risk transfer, particularly tackle actions considered lower. Our labels in the near term will keep the impact of the bank to minimum. Researchers also encourage it to increase the use of collateral, reducing the risk of loss in the event of default, towards the client at a very intensity. On the other hand, by obtaining regulatory exemptions, the model proves eliminating inefficiencies, modeling methodologies, and enhancing data quality. The model proves the result and considerable WA reductions. The contrary, business strategic goals such as strategic control, dazzling WA intensive businesses, separate reliability over the medium and long term. In summary, total risk weight is sound up of the classes of assets owned by banks and modifying the assets according to the degree of risk allows banks to discount lower risk assets. So there's a lot of articles to read in terms of finance for ANZ, Compstates AUT, saying postgrad and postgrad period of finance. As I get better at doing my masters in sports further, I'm starting to start by completing my master's studies in postgrad. God willing. So we're not going to level of Excel live. Thank you for watching my live on fijian jafa capital investments. We're not going to level.